Good morning, everyone. To those of you here in the center, it's good to have you. We've been doing so many things with the pandemic by Zoom that now we have both. And to the folks online, my name is Bill Holloran. I'm with Tiffany Richardson. We're with Norfolk State's Innovation Center and the Small Business Development Center. This morning's effort is an attempt to give you sort of a complete viewpoint of the financial options that might be available to you to consider for financing your business. We'll handle this straightforward. Those of you in the center here, as we move through things, please feel free to raise your hand and ask questions, and we'll deal with those as you ask them. And of course, we'll leave some time at the end of the presentation to be able to do that. For those of you online, if you would simply enter questions into the chat, Tiffany will pick those up and will let me know, and we'll answer those as we've got. So we'll make it interactive and make sure everybody is aware of those particular options. Both of us are consultants and counselors with the Small Business Development Center and with NSUIC's innovation efforts at Norfolk State. And so we'll see if you can stump any of us with any of those elements. So with that, we'll get started. Let's see, what do I just do there? When we start talking about money, I want to make sure that you are prepared to be able to deal with lenders or investors or things like that. And by and large, you have to answer 4 basic questions in order to be able to have that conversation and to start. The first one you can see here on the screen is you have to have worked through and have some knowledge of what the amount of money is that you will need. And be careful here. In this case, you want to do, if you're going to be talking to banks and private investors, you want something with some precision. It's sort of a mistake to walk into a lender or to a private investor and say, I need a range of $25,000 to $50,000. That really tells them you haven't done enough preparatory work yet in order to be able to tell them exactly what you need. So just keep in mind, it's worth the upfront planning to have some idea with some precision of the money you need. The second question they will always ask is, okay, that's fine. I understand what your monetary need is. What will it be used for? For small businesses, generally it falls into these 5 categories. Some of you and those online may be considering buying real estate or owning real estate to help your expanding small business or to start one. And real estate is a separate form of lending, mostly because you can borrow much longer for real estate than any of the other types of activities. The second element is equipment. Equipment can be almost anything from office equipment to heavy industrial equipment or things like that. We get into leasing and those kinds of things to be able to do that. The other elements, when you say, look, Bill, I need money for office supplies, I need it for advertising, I need it for labor and things like that. That is this catch-all category of working capital. Okay, so generally, if you're talking to an investor or a lender, you can group that and say, I need $50,000 for working capital, and they may ask for some breakdown, so be prepared to be able to do that. But that's the catch-all category that comes into play. Some of you may have businesses that need a line of credit. Now, a line of credit is a short-term instrument, less than a year. And it is a lending instrument that is used for a purpose. For example, some of you may have retail operations and you may have a need to buy inventory, and you will probably have to do that several times in the year. A line of credit is an excellent short-term banking instrument for that. You get access to a line of credit, get it approved, you use the money to buy the inventory, you get paid. When you sell that inventory, you pay down the line, and then you use it over and over again. The important thing about a line of credit is it's short term, a year or less, and a bank will ask you sometime during the year to set the line of credit back to 0 so they know they've not given you a working capital loan. Now, the value to you of that is a line of credit. You only get charged for it when you start to use the money. So you may have access to a $100,000 line, but if it's a month before your heavy season starts, you don't pay for it for that initial month. You pay for it once you actually use it. But they want you to zero it out sometime during the year, usually for a period of 15 to 30 days. So you have to know the cycle of buying inventory to do that. So just keep in mind, the best use of a line of credit is to be able to handle seasonal activities, and it's for one purpose. I can give you out an example of a business that I ran. We eventually sell a relatively simple business, engineering, construction, and maintenance, but from time to time, we would win big projects. And all of a sudden, we had a need for a construction payroll. And we had a line of credit in our business where we used that line of credit to be able to pay payroll, because we had customers who paid us in 30 to 45 days. And obviously we were paying people on a weekly basis. And so we would pay them out of the line of credit. Then when we got paid by our customer, which included our profits, we paid the line of credit down to zero and then cascaded from there. So that's just an example of the uses. The one purpose use is best, maybe two at most. Just remember, it is short term and you'll be asked to rest it as a covenant of the loan element to do that. And then gap financing, once again, is just for those of you who might have a quick short-term need. Mostly this comes up in real estate and equipment, where there's a need to install a piece of equipment and you need a little bit of money to get it installed. It happens quite often for those of you who might consider buying a piece of real estate. There is some work to do on the real estate or some construction to be done that's going to take renovations for 3 or 4 months. And a bank will extend you gap financing for that 3 or 4 months to be able to do that. So that's especially neat. What we want to make sure you walk out of today with is the third element, is the expectations of debt lenders. And then fourthly, we want to make sure that you understand what investors, private investors, people who are not commercial banks or government loan programs or things like that, will expect of you in terms of underwriting requirements and returns. This makes your ability to raise money and how much you can raise predictable. For those of you in startup or those of you in growth mode, you might look at this and say, well, I don't quite meet those underwriting requirements yet, but it tells you where you've got to get to, and that will help you know when you become lendable. Questions about that? Those four are pretty important from the start. 5 types of financing. We'll talk about grants here in just a minute. The predominant types of financing, though, are debt. That's a loan, okay? Equity is when you deal with private investors, and equity can get pretty creative, but generally people with equity are going to want an ownership position in your business, and we'll talk about that. Often financing is a combination of the two, debt and equity. You'll discover here in a little bit that once you have equity, your ability to leverage a debt lender and perhaps give up less ownership in your business is something you can do. And then Tiffany and I always try to keep in mind that some of you are at a point where you're looking at just part-time endeavors or things like that. And the final slide, we'll talk about bootstrap financing for raising sums that are under $25,000 and that sort of stuff. So with that, we'll start with grants. So there's good news and bad news about grants. And Tiffany and I will tell you, we know exactly what we're talking about on grants, okay? And I'll hold myself with anybody. I've had lots of interesting conversations, particularly since the internet started in 1995 of all the folks. Do not pay any upfront fees for anybody who tells you, okay, that they can find you grants, okay? Grants are pretty predictable. I can tell you where you're going to be able to look. And generally, no one can guarantee you that they're going to be able to get you a grant by simply providing a list out of it. There are some public sources and you can get them as easily as that. So we'll start with the good news. The good news is if you're a technology firm or you have a new technology idea or something along those lines, there are substantive federal government programs available for you to take a look at. The Small Business Innovation Research STTR program is such a grant program. Every single cabinet level agency at the federal government has a program. Now, this is the other side of grants. Generally, when a government entity comes looking for you, they come looking for something they might want to accomplish. And you may have a technology that they want to understand, but you're going to be fulfilling some government elements. Now, the advantage to you is in fulfilling those elements, you might get to develop your technology or use that. You're going to see here in a minute, a number of people have built out almost entire businesses around an initial SBIR grant. The bad news is that grants that provide working capital are relatively rare. I used to say 3 or 4 years ago they didn't exist, but when the pandemic hit, we started to get some of those. So if you need $50,000 and it's all working capital and you're looking for someone to give you that you're not going to have to pay back, that's a pretty rare find. We'll talk about the sources that you can look at that. My experience, though, is those sources are $5,000 to $20,000. They rarely get to the $50,000 range, and we'll give you a couple of examples here. So then you can see the sources. This Small Business Innovation Research, or SBIR program, is the federal government, clearly the most dominant. A very, very heavy technology basis, just so you know. They do a few other things, but if you track that, you'll be able to keep track, if you have a technology business, as to whether or not there is an agency that can assist your business in development or may be interested in a technology that you are developing. Like everybody else in the private sector, and since Ms. Richardson educated me on this, she was 9 months ahead of the rest of the world on artificial intelligence. There's a lot of interest in AI and that sort of thing over the past 3 or 4 months. There is in Virginia, and remember, our expertise is Virginia and then the local regions in Virginia. That's where our expertise from economic development exists. There is a state agency called VIPC, or the Virginia Innovation Partnership Corporation. They do some grants as well. Another technology, and to some extent, a little bit of an agricultural bias, but they are economic development programs. You can simply go on their site and keep track of those programs and see if they might apply from you. Then we get to the local government agencies, and we can give you actually a couple of good examples, one that is happening and one that went away. Every local city, and we cover the Hampton Roads region, so we have a couple of counties, James City County, Gloucester, Isle of Wight, and Southampton that we cover. Every one of those municipal entities has a Department of Economic Development. If you are going to be a small business owner, you are going to want to keep track of that small business department, the economic development. I suggest small business owners check once a month, because they will almost always have some capital access or incentive programs, and those programs are things that you might be able to tap. So then let's talk about grants specifically. Right now in Hampton Roads, there is a manufacturing innovation grant coming out of Gloucester County, small amount of money, about $30,000, but you have to be a manufacturer. A number of folks, Hampton, Newport News, have facade e-commerce elements. In other words, if you have a building or you need to do something to develop the outside for presentation or for marketing purposes, they will help you finance. Generally, those grants are in the $5,000 to $10,000 areas. There are, the city of Hampton actually has a small program to help with the development of e-commerce in that. Gloucester County just yesterday announced grants in this area. So if you are located in those cities or in those counties, you would be eligible. It's where your business is located. It's not where you live. It's where your business has its local business license that you would want to look at. Another example, and then there are specialized development. Newport News has had for a year and still has on its website a micro enterprise element. You can see the limitation here is, as a rule, these programs fund $5,000 to $35,000. If we had had this last week, Tiffany and I would have been telling you, we had a bunch of folks in the Align class, and we told them the city of Norfolk came out with a 2-week application period for a micro grant, $7,500, and a reimbursable grant for existing businesses for $35,000. $35,000 is kind of on the high side. I have seen some grants that get up into the $50,000 range. So just know, if you keep track of this, you will see them. And they always come with requirements that the locality will want. So you have to read the fine print and make sure that you qualify. if you want to keep track of everything out there, there are private sector grants that come in from time to time. I'll give you an example of one by a person right out of the Innovation Center here last year and a half ago with the pandemic. But there is a federal source called grants.gov. It's not the most user-friendly site I've ever been on, but it is very, very comprehensive, and you can get that. A more user-friendly element, but it comes with a subscription price, is grantwatch.com. That's the sort of all coming. What I like about it is it sort of throws in the private sector. And then, of course, you all can probably think intuitively, any municipal area has lots of foundations, lots of nonprofits. Some of those, in addition to philanthropic activity, might lend money to businesses for specific purposes. In Hampton Roads, that organization is called the Hampton Roads Community Foundation. Actually, if you just got its community report, it's a nice 8 or 9 page element which lists presentations and that from all sorts of foundations and things like that. I don't think it covers everything, but it's pretty close. And that would give you a real comprehensive look at the places that you might be able to do that. And then keep your eyes on Norfolk State and the SBDC, because when we find a private sector grant, we usually tell the people who are on file with us. Let me stop there and see any questions about grants. Or Tiffany, is there anything online? It's always fun to have an audience. Yes, ma'am.
So you said you inform those that are with you. How do you?
I'm sorry.
About the grants for the
SBIR.
SBIR. How do we, with the Innovation Center, get on that?
Yeah, not with it. With SBIRs, if I was going to do SBIRs, this is what I would do. Okay, go to the nobody has a computer. You could go to the Virginia Innovation Partnership, VIPC Corporation, and they will send you. They have a bi-weekly lunch and learn, and they talk about the SBIRs that are coming out of the federal agencies, and they have some working sessions where they train you how to apply to them, and that as well. And if you can't get all that down, give me your name beforehand. I'll make sure you get the next presentation, because it comes to me every 2 weeks. Okay. And I'll make sure you get it via email. But for me, that's the best because it's Virginia specific. It is right there in Washington. VIPC happens to be up in the northern part of the state. And it has a nice learning element that you can tap into by Zoom and things like that, because SBIRs are, I always equate it to like getting a government contract. Okay. And then we play from there. But that would be my suggestion on how you would be able to track that. Okay. Fair enough? Do we have any? We're good online?
Yeah, we're good.
Gotcha. So let me give you a couple of examples. This is the one, this was a child care center that worked with us here and with the SBDC. Verizon had come out with a national grant program, and they were looking for very specialized, they were looking for critical industries. During the pandemic, as you can imagine, there were lots of critical industries, but childcare was certainly one of them. She wanted to be able to develop a STEM classroom. She applied for it, got it in 2 weeks. Tiffany and I would tell you, she sent us a picture of her when they brought her the check. And so she was able to put that forward to the development of this classroom. Okay, straightforward. She had to make an application. She got a check and she moved forward, didn't have to pay it back. Along what you were thinking about SBIR, this is the next two are real good examples. I worked with a technology firm that developed a GPS, a really specialized GPS element, not Google search or anything that Apple can do. And they actually went through all 3 phases of the SBIR. The first phase was $150,000. It helped them develop the product, and they were providing know-how to a federal agency that wanted to use it. It was one of the maritime agencies that did this. And then there was a second phase, which they got funded for. The third phase of an SBIR is when the entrepreneur steps up and says, look, now I've got intellectual property and I'm going to move forward, and they go out from there. But they were able to garner about $400,000 or $500,000 over the course of a couple of years. And it really helped them build their elements. So you can see they were meeting the need of the SBIR, but at the same time, they were getting money to help develop their product and their competency as well. Another example, this person currently exists. He's over on the Eastern Shore. He has a process that, a biological process, he went to a federal agency, the Department of Interior, and they extended him $150,000 grant, okay, in order to be able to study that and provide them a proof of concept in that. Through the process, he was able to use that $150,000 to build out his lab and his logistics capabilities. So there's a small operation over on the thing. So you can see, met the need of the agency to produce what they needed. In the process, they helped him fund his lab and his logistics to be able to do that. And then I just tell everybody in the group with grants, once again, keep your eye on the local Department of Economic Development, where your business is located, because from time to time you get all sorts of programs that are incentives or grants and things like that. They always have fine print, okay? But if you qualify for them, they are things that typically you get money for that presumably can help your money and that you don't have to pay back. Yes, ma'am.
Because yesterday I received a call from, I don't even remember, applying for this grant, a loan or whatever, payback, ERTC, I can't remember what it was titled, but they called me.
Too many acronyms for
Too
me.
many acronyms
That's right.
for me.
That's right.
And I was like, who, what? Will you qualify? Will you qualify? And we found out you qualify. And I said, for what? And it's up to $26,000. And
They said you qualify.
yeah, but they don't know anything
Let's
about
make sure we're talking. These are financial grants. If
I
you,
understand.
I'm great. ERC, is that the earned
That's
return?
it.
That's a different animal.
Okay.
That's simply some taxation that was put in place during the pandemic. And that's right, you can call them. There are all sorts of people doing ERC, and they're not grants. If you had employees, you qualified for a tax element that was put into the tax code, and it expires at the end of the year. You could find any number of folks that would do that, but just be careful. The ERCs become a bit of a minefield. There are two very good agencies that we've worked with at the SBDC, so I can give you a couple of folks. Make sure you deal with money who make their money on the back end. In other words, they're going to charge you a fee if you get the grant, okay? If you get the ERC credit, that's what you're looking for. Beware of the people who want money up front to see if you qualify. It's a fairly complicated calculation. You have to provide them some employee records and things like that. But I have seen everything from people who got $2,000 on that to hundreds of thousands of dollars. And theoretically, you would be getting money from your business activity that you could reinvest in your business, but I don't really count that as grant finance. Okay, that's a benefit of the tax law, and it goes away at the end of this year. So it's not something, these things will be around.
Yeah. I think
Did that answer the question? If
Yeah,
I'm
I
guessing
think
that
they're
it's
doing
the
Yeah,
ERTC.
that's it.
You bet. Any questions online? Very good. So after grants, we go to debt. Now we're into a loan and something that has to pay back. And the big problem for small business is being predictable about your ability to qualify. So you can see these are loans. They have underwriting criteria, and we'll review those in a minute. Here are the best practices for small businesses. Very, very important for those of you who are looking at lending the first time. Very, very important for those of you who are startups, because you're going to have to choose a bank. It is our philosophy that I want you to find a bank that will also give you access to government loans. You may think of government loans, and there are a few from time to time that lend directly, but most government loan programs, you enter through a bank or a financial institution. If the bank will not do it, okay, they submit to the government loan program. If the government loan program approves it, they issue a guarantee to the financial institution. The theory behind that is that the bank, they don't want government loan programs displacing the private sector if they're willing to lend. So I like folks, and not every bank does government loans. So I like small business owners to develop a banking relationship where they know they will get access to government loans, because government loans will take a little bit more risk than the private sector, as you'll see here in a moment. And it's just a good element. It can be online. I just wanted to do that. And then we're going to make you aware of non-bank government loan lenders. For those of you online and here that may have existing businesses, if you have an existing banking relationship and you discover they don't do SBA or government loan programs, I really don't want to break up your banking relationship because that gets into all of your financials and all of that. There are non-bank lenders who do government loan programs, so we'll introduce that concept. So you can go to them and they only make their money on a loan. We have a question?
For a list of grant openings and upcoming opportunities, grants.gov.
Yes, grants.gov. You can do the subscription. It's much more user friendly, but it's not an inexpensive. It's not an inexpensive element. And then as we go through this, keep in mind, I'm going to talk to you about the cost of money. Okay. And I want to make sure that you understand what the potential interest rates are and all of that as we move through this. So here are the underwriting criteria, and you'll see across the top here, those are the three major sources of debt lending for small businesses. Okay. There's not much we leave off in one of those areas. So you can see we start with banks, then there are government loan programs, and then there's a whole non-bank lending source. You might wonder who are those folks, but I bet everybody in the room here knows intuitively. We know insurance companies and things like that lend money. You get access to them through brokers because they don't have a corner office like our local banking institutions that you can go to. Once again, same as with the ERTC. You deal with a non-bank broker. They make their money on the back end from the lender. They don't tell you up front it costs you $300 and we'll put an application. We're going to show you in a few minutes here. We can be very predictive about your ability to predict when you can be financed by a debt lender. Then the criteria are down here on my right, your left, and you see them: management, repayability, credit, equity, and collateral. And the way you prove these: management, you pay because you walk in with a loan package and a business plan that explains what you want to do, and the managing, your ability to manage it, your domain expertise, perhaps other members of your team. You do have to walk in with some projections. Those of you that are existing businesses, they will want to see some historical financial income statements and balance sheets. But if you're asking for $100,000 and you're going to get repaid over 7 years, they want you to be able to show that you have enough profit to be able to pay the debt service on the loan. Okay. They'll run a credit check. And then we have the two banes of small business owners: equity and collateral. Equity is the amount of money you are bringing to the table. Okay. If anybody tells you there's a zero money down deal out there, I can almost guarantee you they're incorrect. But if you think they're right, come talk to Tiffany and I, and we'll check it. And if you prove us wrong, we'll help you submit, and then we'll tell everybody else at the next seminar. Generally, equity can be measured any number of ways. An easy way for me to talk with everybody in a seminar is a debt to equity ratio. So all that means is for every dollar you put in, the bank will lend this much. Okay. Banks, as a rule, will be at a 2 to 3 to 1 debt to equity ratio. So, for example, I'm having a conversation later this afternoon with an individual who wants to raise $400,000 for her business. And we've already had this conversation once, and she knows she's probably going to have to raise about $90,000 to $100,000 to be able to do that. That doesn't get her within the bank range, okay, but it will get her within the range of the SBA. The SBA, as you can see, will take more risk, 4 to 6 to 1, okay? So you can do that kind of math in your head to do that. And then remember, the existing businesses in the room, you have a balance sheet, probably with some cash that's going in and out of the business that would count as an equity side. All of you should keep in mind that if you need large sums of money, equity may not be just your money, it can be you and your investors, okay? So you can bring everybody to bear to add that up and then determine what can be done along those lines. Then you can see the government loan programs, 4 to 6 to 1, and then the non-bank lending sources will take quite a bit of risk. So their equity requirements get variable, but they charge you for it, okay? As you'll see down here. So you can see that's the theory. Banks have often said they want to be the low-cost lender, and they are generally for small businesses. but they don't break off. I've often said to my banking friends, I said, why don't you just charge a higher interest rate and do that? But that's not their market. Okay. They want to be the low cost lender. When we talk about cost of money, if you ever get a loan agreement, it will come to you with a term sheet and the interest rate will be, we'll say prime plus something. So you have to know the prime rate, and then you can see banks will lend you at 0.5 to 2 points above the prime. So you'd be able to calculate your interest rate. Government loan programs are not too much worse. They are a little bit higher. I've seen SBA loans as high as 3, but the norm is really 2.25 to 2 3/4 above prime. So you can see that doesn't break the bank or anything like that. The non-bank sector can get to 3 to 7 points over prime. So you can come to me and I can say, I can probably find the money. The question is, we need to run the projection and make sure you can afford it. And then we do a couple of things. We teach people a couple of things to deal with non-bank lending sources that can go there. The fifth area is collateral. Sit down with the banker. They like the business plan. They can see you can repay it. You're putting the amount of investment, and you face this inevitable question. What happens if the business doesn't work out or the growth expansion doesn't work out? What a terrible question to ask a small business owner, but you will be asked by debt lenders. The only answer to that is that there is collateral or a secondary source of repayment. It may be the most difficult thing that small businesses have to come over with. Banks generally want to know that they're going to be repaid 100%. They're going to be the low interest alternative. They want to make sure that they can be repaid even if you can't do it out of the business or if the business fails. Government loan programs will take 80 to 100%, and actually they focus a lot more up here on cash flow than collateral, particularly the Small Business Administration. And then you can see the non-bank lending sources will take risk, but your interest rate will go up correspondingly based on how they're rated. Everybody got that? Okay, so here are the sources that play that. Okay, banks, low cost alternative. If you can grow or grow to the point where you can qualify for a bank loan, you should go there. By and large, with rare exceptions, okay, they will be the low cost alternative. Then there are the government loan programs. The COVID programs are still finishing up, but there's still a few out there. ERTC is a good one, okay? And the dominant federal agencies for loans are the Small Business Administration or the SBA. And for those of you that may be online or here that are in one of our agricultural areas, Isle of Wight, Gloucester, the Colonial area, the USDA, the United States Department of Agriculture, has some substantive business and industrial loan programs that are available to folks in those regions. So those are the dominant ones. For the SBA, the 7A program is for working capital. Okay, so if you have a working capital need, that will be the program you're applying to. Those of you that are interested in buying real estate, and this is small, that means you're a small business owner and you want to buy real estate to house your business. The 504 program, the SBA 504 program, is one of the better government loan programs out there. Its advantage is it only requires 10% down. It's structured as a 50% deal from a bank, 40% from the SBA, and 10% from you. Generally, most real estate lending, if you're with a bank, might be as high as 10 to 20%. I realize not everybody here online may be at this stage, but if you grow your business to the point that you might want owner occupied, remember 504. It is a program you will want to remember because it's a well-structured deal. SBA Express is one of the line of credit programs with the SBA. And then just in case we have any of you who are starting to do business overseas and exporting, there are special programs, and the SBDC maintains a service to help businesses who are getting into export. Those are the federal programs. The state program, there is an organization called the Virginia Small Business Financing Authority. Look at their site. They have a program that does the same thing as SBA, doesn't quite go as high. The SBA can get up to $5 million in terms of the amount they can lend to an individual business. The financing authority is more like 500 to $1 million. They do have a couple of specialized programs. They have a micro grant program. They have a child care program. And once again, this is another one of those areas that is changing from time to time. So take a look at that. If you find something of interest to you and it wasn't explained here in the seminar, or you can ask me a question, you can just call us here at the center or at the SBDC. And then once again, just like they have grant programs, the local departments of economic development will have loan programs as well. Generally, loan programs at the local economic development, once again, we start to get smaller. We start to get into the $50,000 to $250,000 range, but it can often be augmental. I have seen some very creative small business owners who got money from a bank and needed an additional $50,000 and used the local Department of Economic Development programs to fill that gap. So you can get real creative with those elements. That's debt. Questions about loans or anything that you may have countered? And I know, Tiffany, did we have one or?
Yes. So do you have any suggestions for someone with not so perfect personal credit? And are there any banks or agencies that work with this situation?
Yes. Now and then remember, credit is a continuum. Okay. So my first recommendation, I'm doing this with a client right now. Credit had gotten well out of hand. So I have a couple of credit counselors that I work with, and we simply put in place a 3 to 4 month program to get her back up to the 700 level. And when you're in the 700 level, you're going to take a look. If you get down into the 630 or 680 element, it depends on the program. Sometimes the financing authority will take a look. Sometimes the SBA will take a look. The trouble is getting by the bank, okay? Because banks worry that a falling credit score shows a problem with repayability, and everybody in the end just wants to be repaid. So it depends upon the individual situation. But the other part is just to take it from there. There are lots of reasons credit goes awry. You'd be amazed at what you can do to get yourself back into range just by starting to pay your bills for 3 to 6 months. Stop applying for credit, because generally you can see the chart I just showed you. You might have noticed these banks and government loan programs evaluate all of you the same. And they do by and large. There's some idiosyncrasies with loan officers and things like that. But you might be amazed at what can be done with just correcting your situation by paying your bills in 3 to 4 months' time. I have a great example. A husband-wife team walk in. It was just before the pandemic started. They had a very simple shoe business, knew it upside down, and had been at it for 20 years. I remember because it took me 20 minutes into the interview to wonder why they were here. So they were laying out their business plan to move forward. They needed $45,000, small amount of money to restart. And so 20 minutes in there, I'm going there and I said, you have domain expertise. What do you need me for? And they said, we have a credit issue. Okay. The reason they had a credit issue is because the wife had gotten cancer and they had spent 2 years getting rid of the cancer and eviscerated the wealth they had built up in the first 20 years of this business. It was all he knew. Okay. So this was his next step. So we put together a business plan. In this particular case, we went to a state agency. We told the story, okay, and they got passed through. The other thing that passed over, to answer the person online too, a divorce that wrecks things, but everything pre-divorce can be shown to be good. You've got domain expertise. Those are stories that can be told where a bad credit rating might be overlooked, okay? So just keep in mind, there are some examples. You may hear some stories and some of them are true. And I've actually had 1 or 2 of them. And once again, I moved through with the business plan. I did not know they were going to get approved. I told them credit may be an issue, but in the end, once they explained the story, the people met it and they saw the expertise and all of that, they were good there. See if that handled the lady. That's the best I could do on credit. If or ask you the next one. Questions about debt? Fair enough. After debt, oh yes, I did want. There is the non-bank financing sources. So keep in mind, there are leasing firms out there. You can go out and lease equipment, okay? It might cost you a little bit, but you eliminate the need to have upfront funds by and large, or very small amounts. There are equipment lenders, there are commercial financing and asset-based lenders that do everything banks do. Just remember, in these particular cases, you access them, okay, via brokers or in our developing fintech community. If you decide to look online for non-depository institutions and things like that, give the SBDC a call. We've developed relationships with 5 or 6 of them. The fintech world is full of very, very good things and very, very bad things, okay? And we've had some luck with working with folks like you who have used our technology expertise to attack the financing organizations in fintech. But fintech can be a little bit of a minefield depending upon who you're dealing with. Accounts receivable financing is for those of you that are either government contractors, or if you're a business that sells to other businesses where you do the work, they extend terms to you, they only pay you every 30 to 45 days. There are accounts receivable, they also call them factoring organizations, who will buy the receivables, extend the cash or 90% of it, and then when you get paid in full, they give you the remaining 10%. They do that for a fee, and that's what you would have to negotiate for them. That's only for those of you selling business to business or government contractors, because these financing organizations are evaluating the creditworthiness of the person that you are working for, okay? And but it is a very, very good way to do cash flow, and I'll give you an example of that in there. And then I like all small business owners to sort of just take access to capital as one of their core competencies. You'd be amazed. I've been at this for too long, and but there's some real specialists out there. I mean, I could take you to 2 lenders that will do startup doctors or physicians and dentists. You may think a startup doctor or dentist has pretty good credentials, and they probably do to practice. But when they're in startup mode, the financing industry is not really crazy about them. But there are some folks who have become real specialists in lending in those particular areas, just to be able to give you. And you never know when something crops up that will deal with you or deal with your individual business. So just something to keep your eyes on as to what the sources are and their requirements. And now you know to always ask them about the underwriting criteria. That will make you conversant, and you'd be able to do a quick assessment as to whether or not they could be beneficial to you. Couple stories. I think, yes. This is actually, the business is still in existence, 25 years. One of the very, very first businesses I worked with at the SBDC. The individual wanted to start a retail business. He was an inventory. He was a veteran. He had $73,000 to finance his initial inventory, and he needed some working capital. He had $25,000, okay, and he had personal assets. He was willing to put his home up as a personal guarantee. Wrote a nice business plan, clearly was developing expertise. We went to the bank. Bank said no, but he had met Bill Holloran. I'll take credit for this one. And we were dealing with a bank who was willing to submit him to the SBA, which they did. And the SBA approved him as a startup, issued a guarantee to the bank. He actually sells online today. He has 2 operations in Hampton Roads and has been around now for over 2 decades.
But he's a veteran.
I'm sorry?
But he's a veteran.
He was a veteran. The veteran, though, didn't make a difference. Keep this in mind. Those underwriting criteria I showed you, by and large, they will apply regardless of ethnicity, veteran, gender status, or anything along those lines. There is very little that is just set aside that doesn't do that. To your point, we did make the case that it was a veteran-owned business, but I don't think the underwriting criteria do that. I don't hesitate to tell a lender that it's a small business, that it's a Black-owned business, that it's an Hispanic-owned business, okay? Because occasionally, it might get you over the hump. What it doesn't do is it won't allow you to walk in with nothing. You've got to be in the range of that. You can see that's what happened here. I think it probably helped a little. He was in the range, okay, for the bank. The bank looked at it, but then said, and it was actually because he was a startup. I said another year or 2, and he would have been fine. okay? But he was a startup, so it was more risk than they wanted to underwrite at the time. And I do think the veteran-owned status said, yeah, we'll take a shot at this with the SBA. And the SBA says the same thing about small disadvantaged businesses. So I'm sure, as I said, it made an inkling of a difference to get over the hump to financing as a startup.
So was the personal assets that you used for collateral, was that part of your teachings or?
Well, no, he brought the personal assets to the table. And now when you come meet me, nobody wants to put up their home for a loan. Okay, I can tell you, I've been in 4 businesses. I was in a business with a management team that grew to 150 million. We in sales, we needed a line of credit every year. We walked into the bank every year and kept increasing that line. We sold after our 12th year, but it was the 8th year of our existence. And you could see we were becoming a reasonably substantial firm before they let us off personal guarantees, okay? I have in my history at the SBDC had 2 startups who got financed and didn't have to sign personal guarantees. I tore up trying to figure out what we did right with that banker, came to the conclusion the banker just overlooked it, okay? So people who tell you that you might not have to put up personal assets, if they've got a technique, I would listen. But most small business owners, particularly in startups or their first 5 years of existence, may face the need to sign a personal guarantee to be able to do that. Fair enough? Yes, sir.
What if you're upside down in your house? I can put it up.
Well, say if you're upside down, then I sort of wait, okay? But if you're upside down in a house or something like that, but you have other collateral, you run a collateral, a house is easy because everybody understands it. But you might have equipment, personal assets, and things like that that can be individually add up to your amount. If you're upside down, I wait till that situation corrects itself, or I start searching for an investor that might be able to help. That means I might have to give up some ownership in a business to be able to qualify for that. Fair enough? On a bigger level, this is the 504 program. I just never like to forget, if you got anybody in the audience who is thinking of buying their own space to house their business, this was an engineering service firm. They were a little bit unique in their spacing needs, and they wanted control of rent. They were tired of their lease rates going up every year. So they were profitable with some growth, but they didn't have quite enough cash to meet the underwriting requirement for the bank. This was where the 504 program with this 10% owner effort, only 10% up front, okay, meant that they preserved what a bank might have wanted was 20 or 30%. They preserved that extra money for their working capital needs, and it allowed them to move forward probably about a year and a half faster than they thought they were going to be able to be able to buy their own property. And you can see it was quite a substantial deal. In the end, they financed this 1.365 million, 10% was their money. Everything else came from the SBA and from a bank. So once again, the 504 program, I tell people that the government loan programs don't do everything right. Okay, but whoever designed the 504 program designed it correctly. Okay, it's very helpful to small business owners because of this 10% down. It can be used for that, but then keep in mind the difficulty with the 504 program is it's only for real estate and equipment. It will not do working capital. So that's its bane. Yes, ma'am.
Not to divulge anything, but
yes, if you know, these are all folks who gave me permission. You can see I talk in the third person. This one makes me nervous. I mean, there are plenty of engineering service firms, but this one, if you know it, just don't say who it was. Okay. Yes.
But I wanted to know the 136,000 that they put down, was that as from one of the owners or the?
In this case, it was owned by 2 people, and the 10% they put down, this was an existing business, came out of their cash reserves. In other words, the business was profitable enough to generate the cash reserves for the 10%. They actually had a little bit more money than the 10%. But when they went to the bank says we want 20 or 25% down. They didn't have that much, or it would have tapped all of their working capital reserves, which they didn't want to do. That was the value of the 10%. Fair enough. Okay, yeah, it's a well done deal. Just a couple of other examples to give you the full range before equity. This is non-bank lending, specialty contractor, 5-person outfit came to me. Okay, they needed $56,000. He had run a truck with 3 employees for 6 years successfully. Ran a really nice business. Then he got more work from an additional customer and he needed an additional crew. Pretty simple, right? Bank won't touch him, okay, for whatever reason. And he's been banking with someone for 3 or 4 years. In this particular case, we went to the non-bank sector. I have a couple of brokers we're working with who make their money on the back end. And it was most interesting because the broker called me back when I briefed him on it. The guy who actually had his commercial insurance with a firm, but he never knew about the financing part of the insurance company. So the insurance agency that he had as commercial insurance agent actually extended him the loan to be able to finance the $56,000. And it was 3 points above the prime. So it was, it was fairly fair from that standpoint, but still in business to this day, never really wants to get much larger. I expect to see him the next time he needs a 3rd truck or some new customer he can't turn away comes in. But really, really nifty guy. And then this is the accounts receivable financing group. Another story, and this does happen all the time to those of you who are in government contracting or selling business to business as opposed to consumers. In this particular case, the client came to the SBDC. They had just finished their annual workout with their bank and had received a line of credit because they were operating quite well. Okay, they get a month down the line, and what happens is they get a very, very substantial new government contract they didn't see coming that they can do. Okay, so what's the first thing they do? Just exactly what you do. We pick up the phone, we call the bank. Hey, we were just in there. You just approved it, and if you up this line this much, we'll be able to do this bank. That's what the bank said. Okay, said, oh, it's a little bit more risk than we want to take. We want to see a full operator. We want them to wait a year and come back in, and then they would consider it. Okay, which is all fine and dandy from the banker's perspective, but now you're a small business owner who has to turn down work that you can do. So we got him with an accounts receivable financing firm, okay, and they bought the receivable as they did the work for the government from them. That financed the cash flow to be able to do the work. And then 1 year later, 1 year later, after he had done that for a year, because accounts receivable financing is more expensive than bank financing, we walked him back into the bank and they approved the line of credit for the new increase. What we did to here, for those of you who do this, explore these accounts receivable lenders. There are 2 very good ones in the Hampton Roads region, and let them tell you what their cost is. In this individual's case, what he did is we got the package in place, and then he increased his price the 2 percentage points that this was going to cost him. So he built the extra cost of money into his new contract. It didn't make him uncompetitive, and so he was able to recover that cost. And you might not be able to do that with the very first one, but once you're cognizant of what they cost, you can move forward from that. And it's another way to simply recognize that I can deal with a little higher cost of debt. I'll recover it in my pricing strategy. Fair enough. So those are good debt examples. Let's give you equity. So now we cross the line from debt to equity. Now we're dealing with individuals, family, friends, and relatives, private investors, venture capitalist groups. And this becomes the discussion. These folks, as you'll see in a minute, don't have all the underwriting requirements. They want to know that you will repay it and that you can manage your firm effectively. They get an ownership stake in your business. That's what they're going to negotiate. The big question is, how much are you going to have to give up to do that? Now you can see the advantage to that to you is you get paid out of profits. Generally, if I'm an investor and I invest in your business, I'm going to have quarterly updates. At least that's my policy. But and then once a year, we're going to sit down. We're going to look at how profitable the business was. We're probably going to take some of those profits and reinvest it in growth options, but we may pay out some of it to the investors and to the owners. And if I own 20% of your business, I get 20% of that amount. Okay. If you continue to operate successfully in years 3, 4, 5 through 10, and I'm a 20% owner, I make money at 20% for a very, very long time. Okay. That's the advantage of ownership. The downside is I don't get collateral protection. And I add to your equity requirements, which means that if the business fails, then I fail with you. Okay. Whereas a bank is going to come looking for collateral. That's the difference when you cross the line with equity. And then you'll see this could be very creative. For small businesses, you can see the point here is once you bring equity, in other words, if you didn't have a lot of money, but you found me and together we get into those underwriting requirements, okay, you might use my equity and yours and then leverage the rest with a bank deal because you can afford the debt service and you have to give up less ownership to me. That's the best team. Almost always investors are looking for management team. They want to know there's more than just you, okay, unless it's a very small amount of money, okay. They're looking for sizable market entry and barrier to entries because a 20% rate of return is higher than what banks make, okay. So we go from there. And then this is just something the individual who introduced me in my 20s to small business ownership taught me. He said, always remember when you're dealing with other folks about money, everything works best when everybody makes money. So I've never forgotten that. I call it the McLaughlin maxim because that was the name of the individual that did. So let's talk about the sources. Once again, same element, but you can see, look at the criteria now. Credit, equity, and collateral go away. To answer the woman or the person online earlier about credit, keep in mind that generally investors do not do credit analysis. So if you've had a bad credit, you have to disclose that, okay? But if you have a credit issue, it's generally not a reason to get you, particularly if it's a person that you know, who knows that you can do what you're going to say, maybe knows the history and all of that sort of stuff. So they're not running a FICO score credit check on you as a rule, and that is an option. It was actually what I was going to do with the cobbler if we were unable to find them debt financing. So you can see, but still investors want these top two. They want to know that you can run the business, and they want to know how they're going to get repaid and when. Most investors don't look most investors are not looking to be repaid in the first year, maybe even the first year or two. So they give you some time to get up and running. But just keep in mind, the need to give a rate of return is attributable. So credit, equity, and collateral go away. The cost of money here is convertible, and then it's a negotiated element as to how you did it. Okay, so let me give you a couple of examples, and you can. These are the sources. Remember when your parents told you never do business and never lend money with family, friends, and relatives? Couldn't be further from the truth. Okay, there's more small business lending that goes on here. I always recommend reducing it to a business relationship, a formal agreement, and all of that sort of thing. That's one of the things that helps people network. There are private investors, they call them angels and angel networks. There is one in Hampton Roads called the 757 Angel Network. You have to apply to their program, but you can do that. Generally, there is some crowdsourcing developing. Once again, if you want to use crowdsourcing to find private investors, come talk to us. There really only are 2 or 3 of these that are good for small businesses. There's a lot of crowdsourcing for philanthropic activities, but here I'm talking about crowdsourcing to find private investors, and they're really not that good yet, but this should get better. I'm really trying to stay up to stuff on this because this ought to work, giving people access to more private investors throughout the area, and it will eventually. It will just take some time. There are some government equity programs, small business innovation grants. We talked about earlier the Virginia Innovation Partnership Corporation. They have equity financing and venture capital programs. So when you look at their site, you will run into their equity programs, and they are specifically for firms that are located in Virginia. And then, of course, there are the venture capital firms. That would be full. Well, we've got Jim. There are 1 or 2 venture capital firms, but keep in mind when I use the term venture capital, I'm talking about the firms that are looking for the next Google, the next Apple. There's nothing wrong with any of your small businesses or any of the ideas that are here online, but venture capital firms want industry creating ideas. That's what they interest. So they're looking to invest relatively substantial sums in management teams that have a potential to become, to grow from a small business to a mid-sized business. So that's how I differentiate all of that from there. And then a couple of examples. This was a retail operation, a simple business. A lot of inventory though, needed about $300,000 to start a business. This is what a husband and wife team, this is what they did. They actually formed an LLC and they gave up 18% of their ownership in the LLC and got $200,000 to begin the business. Still needed 100, okay? And they actually went and found another private investor. They didn't want to give up more than 18 or 20% interest. So they went to another investor and they offered them a debt deal for the additional $100,000. So they didn't give up ownership. They did pay a higher interest rate than what they would have paid at a bank or something like that. So you can see this is the creativity of you all and the folks online as to how they made this work. So they gave up what they wanted. They found a private investor. Over the years, they've actually, over the past 4 or 5 years, have opened 3 operations, and they are just now beginning to qualify for banks. And it's a successful element. And they went through the post-pandemic. Boy, they started a year and a half and hit the pandemic at their 1.5 year thing. It was quite scary for 2 or 3 months because it was retail. When we closed down those 2 or 3 months, it was there, but they were innovative with what they did. All what you all can do sometimes was amazing. They actually called me for help. I walked in with all of my research, and then I just sat there and listened to them and their employees, and they figured it out. So just amazing. This was a financing organization. This was a former banker. He started a business and he wanted to be able to lend money. Okay, in his case, he sold 33% of the firm at startup to a wealthy private investor. That's what he did. And then they went to the bank and were able to use that to qualify for a line of credit. Okay. They were doing short-term financing so he could make the line work up and down. They raised quite a considerable sum. It was close to 7 figures at startup. And the firm has been around for 20 or 25 years. And once again, if you know who this is, don't say something, okay? Fairly simple one that just came in a couple of years ago. I had an individual, a contractor walk in who wanted to rehab houses, okay? He had done it for other people, and he is in the process of doing that. He needed $100,000, okay? So that he could go out and buy houses, he could do the rehab, and then he was going to buy them with some, he's either going to sell them or turn them into rental property. And he wants to get about 10 of them. He's in his second one. In this case, same as with the Lions folks, he didn't want to give up any ownership. Okay, so he proposed a debt deal with a fairly high interest payment and found a willing investor. But you can see his advantage. He can pay he pays a high interest rate for about 2 or 3 months, sells the property, goes back to zero with the investor, and then reuses the $100,000. And he's looking for a very specific type of house. He operates from the Eastern Shore through Hampton Roads up into Middle Neck. But that's what he's trying to do. He's trying to build a small rehab, and he is going to keep some of them because he wants some rental properties for income. Get the idea? Okay, and you can see from there. So those are for the startup looking to become full-time. For those of you that are full-time existing businesses, I do keep in mind that there are lots of businesses out there that are part-time. My definition is fairly arbitrary, but these financing sources are for businesses where your sales level is $40,000 or lower, and that's what you want to do. In other words, you're part of what they call the gig economy. You're using it to augment a job or something along those lines. Very hard for a bank to get their arms around it, and the amounts of money are small, and they don't think they can make any money at it. I happen to disagree with that, but it's their call. So that. Once again here, knowing the cost of money is important. I'm a real fan of using any of these as long as it's project financing. In other words, you need this money for 2, 3, 4 months. I don't really have to worry about the interest rate because you're going to take it back down to 0. Okay. And 17% divided by 4 turns out to be 4 or 5% that you actually paid as a fee. Okay. I'm not a big fan of running credit cards up for 2 or 3 years. Okay. I know small business owners do that. I'll run debt service and include it. I get real careful about it, though, in terms of making sure that you can cover that kind of debt, because those interest rates start to get up into the upper teens sometimes. And sometimes that means it's just more expensive than you need. But credit cards for project stuff, step by step, and using them for cash reserves is very effective and is used by small business owners successfully on a part-time business day in and day out. Here are the sources. If you have a home and you have any equity, a home equity loan it can also serve as collateral for a broader loan, but you can tap that and use it. Suppliers, you'll see a great story here. If you can get a supplier to extend to you 30, 60, or 90 days term, I'm going to tell you Jennifer's story. That's not her real name, but you'll be amazed at what she did with that. Suppliers extending you a line of credit, if you can get them to extend your credit where you don't have to pay them for 30 or 60 days, and then you can get the product from them and turn it in that time frame, it's just like getting a line of credit. It tends to be lower there. Lots of part-time businesses and some very, very good business models use customer financing up front. So you get a portion of it paid ahead of time, and you use that to finance your needs. Credit unions and banks, just like they do commercial loans, will do private loans with you, and then you transfer the money into your business. If you have a cash value life insurance, the financial planners will tell you you should have bought term, but if you bought whole life, it probably has some cash value in it, and it can be tapped or used as collateral. So if that's hanging around the house, that's there. If you have brokerage accounts, that's as good as cash. Retirement funds, be careful here. I'll give you an example. Retirement funds usually come with a penalty. You take the money out of your retirement fund. If it's not back in 60 days, the penalty is pretty onerous, okay, for that. So I'm not a big fan of that. What I like retirement funds is for you to read the fine print and see if they will allow you to borrow against your account. So we don't run into the problem of you getting hit with the fact that you withdrew from a retirement account and didn't save the money for retirement. Then we had the high interest folks, the consumer finance organizations, and the credit cards. We can almost always get sums of $10,000 to $25,000 here. We have to watch the interest rate. I like it, as I said, for projects where you're going to need the money for 1 or 2 months. You're going to pay it down to 0, and then you're going to use it again. That's a very effective way to run a part-time business, and this is a very quick way to be able to get money. So once again, I just want you to keep your eyes on the interest rates and remember, the interest rate is always higher for cash. Okay, that's what we're talking here. I've seen a number of you buy a credit card and they just buy their supplies with it. Okay, and I watched, there's less of this right now, but there was a time when there were entry-level credit card amounts that were normal loan rates, and they extended it for a year. And if you needed that for a purpose, that was great. Okay. And it was every bit as competitive with banks, but once again, small amounts of money. Then there are microloans. We don't have a microloan in Hampton Roads. There is a microloan program with the Virginia Small Business Financing Authority. We'll do amounts from $0 to $50,000. I have seen established businesses who could use microloans. We've been trying to figure out at the SBDC how to get one in the region. Those of you who may be coming from outside the Hampton Roads region or online, check your local departments of economic development and make sure you don't have a microloan program that fits there. So that's bootstrap, okay, mostly for part-time, can certainly be used for gap by the existing businesses, and we go from there. So with that, I think customers, a couple stories. Customer manufacturer, cabinet maker, okay, part-time business, had a full-time job at the shipyard, okay? He wouldn't mind me telling you that. He's the one that did the 60-day term. So he sold substantial furniture cabinet deal to a family. and he tapped his retirement funds, which is where he had his cash, for $43,000 to buy all the supplies and everything that were necessary. He tapped the money, bought the supplies, built the cabinets, got it delivered, and got paid, okay? On day 58, okay, is when he replenished his retirement account. So no penalty. So you can see creative, okay, little bit on the chancy side, but he knew what he was doing. And that. The other element is once we did that, we read the fine print, so you know where Bill Holloran gets all, you all teach me these things. We read the fine print, found out he could have borrowed against his retirement account. I had never heard of this. This was a few years back, okay? And he has done that to this day. He actually does about 6 or 7 deals each year along with his part-time jobs. He's used this to fund college for a couple of kids and then retirement efforts for over the past decades. I have seen numerous folks, as we talked about, use credit cards, okay? Once again, I like credit cards for project financing. I can't tell you using them, okay, for long-term working capital for a year or two might work. I actually see it work quite often. I just want to run that cash flow statement and make sure you can afford the interest rate. And then as your business begins to develop its own capability to meet collateral and equity requirements, I want to return to the bank and get a lower cost of financing. And once you get a year down the line, banks will be receptive to this, because if you used credit cards responsibly for a year and then you walk back in and simply say, look, I simply want a write of credit to replace this because my interest rate will go from 17% to 9%. That makes all sorts of sense to anybody, and it certainly makes sense to a banker that you are lowering your cost and you're creating a commercial loan officer. So you can see how you put that. And then Jennifer, it's not her real name, but she was just someone I helped with a business plan and then watched her do this. She had a services firm where she had to buy some things, okay? It was about $47,000. That's what was going to take her to start. She found 3 suppliers, and with each of those suppliers, negotiated 60 and 90 and 90-day terms. In other words, they gave her 2 to 3 months, okay, to be able to repay. She got the inventory she needed, turned it, okay, and then repaid the suppliers before the term was done, okay? So almost, she had a little bit of money, okay, I think $5,000 or $6,000, okay, that she was starting with. But she used this to be able to get what is now a full-time venture off the ground. And she did it, okay, for about 1.5 to 2 years. This is how she turned it. So she was active on sales and doing all of that sort of stuff. But I just watched this. As I said, I helped her do the business plan. I remember when she told me she was going to do this. And I went that. Actually, I know what I said to her. I said, if you do this and do this successfully, I'm going to tell stories about it. And when Deborah Farley and I went back and put this together last year, I went to her and I said, look, I want to do it. She says, yeah, you can tell the story, just change my name. So, because she would be readily identifiable. Okay, there might be folks online now who would know that. But once again, you can see the creativity that any of you can apply to this or a combination of activities. So, make your business case. These are Jim Franklin's questions. They should be up here. Okay, just to start from a business plan. What are you selling? Who's going to buy it? What will they pay for it? How are you going to make money? That shows repayability, where you want to go and grow it, particularly those who are existing. What's your next step? And then figure out whether you're going to deal with debt, equity, or a combination of the two. And generally, you have to arrive to a financial organization with a business plan or a loan package. And if you need help with that or you've never seen one before, just contact us here or at the SBDC. That should be it. I can take questions from anybody in the office or anybody online. So just a second, go ahead.
So are you able to assist out-of-town businesses?
So let's be completely fair to them. The SBDC, I don't think Norfolk State, if you're a Norfolk State alum, I don't think there would be any limit because we've dealt with out of state. We have,
Right.
Okay. So if you're a Norfolk State alum, you can come through the Innovation Center. Through the SBDC network is Virginia-wide. My knowledge, and competency extends to Hampton Road. So it's the Colonial Triangle through the peninsula, down to the south side, and then we do the Eastern Shore as well. There is an SBDC network in Virginia, if that's where this person is, so I can get, if she's not, if she's, gosh, there are 2 states that don't have SBDCs, and my God, I don't. But tell the person, Google SBDC Maine, and he should be able to find that. If they don't, then tell them to call us back, and we'll make arrangements. There are 2 states that don't have an SBDC network, but there are folks like me all over the country, usually in state networks. Maine just might be one of those states. I should remember the 2 that aren't, but I don't offhand. In Maine, if you said California or South or North Carolina, I was going to say, no, I know they got it. So, but so tell him, check, if he puts in Maine Small Business Development Center, if he doesn't get an answer, then tell him to call us back.
Okay.
Gotcha. Yes, sir.
You have people that call your house and ask you about selling or buying your house. Do you need it to sell and to buy, to flip or whatever? You need a real estate license, or you just sell and buy a house?
It's a great question. I would reserve that for the attorneys, but I've seen my fair share of real estate business, and generally they go get a real estate license just to protect against the regulatory element. The trouble is, see, you get into the business and then you might want to own it for property management. So I think most people would say is not a requirement. But then you find out someone wants you to sell it, and then you want to sell it because you can find it in an individual deal, because now you're in the business and now you need a realty license. My experience is that most people that enter their world go ahead and get the real estate alliance, and that it doesn't make that. The real direct answer depends on exactly what you're trying to do. It's a highly regulated space. I talked to a commercial real estate attorney. I bet someone would answer that question for you, so you could describe your situation over the phone without you having to go in. But my experience, Isaac, the person that I talked to down here, was he went ahead and got his real estate license just to be protected against it. And in the end, he's a contractor. And he's required to be a contractor with DOPR, the state agency that does those kinds of licensings. But even he just went ahead and got his real estate license just to be protected against it. And you can see, he may sell it. He wants to turn it into an income producing property. But if he got the chance to sell it, or somebody offered him more money than it was, he'd want to be in position to be able to do that. That answer your question? I'm pretty sure that's correct across the board. And that is what I've seen. Yes, sir.
When it comes to like the private investors,
Yes.
is it like the normal standard practice, like I guess when people give up part of the ownership, is that so the loan is paid off and then like terms change, or is that like an ongoing thing?
So I'm not sure I understand. If you engage a private investor, I want you to be engaging a private investor, giving up ownership, but the money is going to be used in the business. It sounded like you wanted it to pay off loans or something like that. I didn't get the last part. Or
I guess maybe I'm saying it wrong. Like for instance, okay, let's say so Shark Tank. Let's say like they invest in these people.
Yes.
And for a percentage of their company, let's say I invest in you $2 million for 10%. Now let's say after all the sales, I've got my $2 million back. That's like that.
No, well, then I think I know what you're talking about. So let me give you, I don't watch Shark Tank that often. Actually, I think it's a reasonable show. You just have to know it doesn't happen like that.
Right.
The due diligence being done up front on that show and on the back end is that. But let's do the show. So they get an offer and they says, I'll take a 10% element. I'll give you $1 million. And they're looking at a firm that maybe has to buy something, inventory. And they say, and I'll extend you a $250,000 line of credit. They are offering an equity and a debt seal. So they want 10% of the profits. And they probably know that business can't quite meet the underwriting requirements. They say, I'm going to remove that worry for you. Okay. And I'm going to extend the line. Okay. I want to know what the interest rate is. And they never tell you that on Shark Tank. I assume the interest rate would be a little bit higher than what they could get at the bank. So you can see now the shark is making money on the debt service. He probably makes that individual start paying the debt service right away. The equity investment comes out of profits at some point when it comes there. So that's what they're doing. Does that make sense to what you're doing? Okay. And then I've actually seen it once where they did that and they told them, and you don't have to start paying the debt service for 6 months. I've seen that kind of stuff to allow the business time to get going. But generally, you can bet that's an investor says, I can see all of that. I know he won't be able to go to a bank, because if the owner was sitting there knowing I could go to the bank and get that 250, I said, I'll give you the 10% ownership. I'll go find my own line of credit, okay, because it might be at a lower cost. But probably the shark knows it might have been a startup or something like that, or a real new novel idea says, bank's not going to tolerate him for that amount. I know he needs a bunch to buy inventory, so I'll extend that as well. So you see, you have a combination. You have equity for ownership, and then you have a debt deal coming from a private investor, okay? And I see that kind of creativity from owners all the time. Particularly people who don't want to give up all the ownership, okay? Or something along those lines. So that answers it. That gives you good, very good. Other question.
Are there any funding options specifically for NSU students?
For NSU students, I think all of these would apply. Okay. The question is, gosh, they're doing a lot just to graduate or get through the graduate programs. But if it's a part-time business, I would use the bootstrap options. Is there a fund at Norfolk State just for Norfolk State students? I think the answer to that is no. Now, here's what does happen. And because we've been part of this, lots of colleges will run pitch events, is what they call it. So you have a business idea and they get a small amount of money. I've never seen a pitch event more than $20,000, generally 5 to 20. And firms come, they go through a training program and then they pitch, okay, the best idea to a group that makes a decision to determine a winner, and they get a check for $5,000 to $10,000. Now I know, and we've done that. We've been in programs. We've been at boot camp programs where they had that, and it was a boot camp program, and then it ended. So I'm not aware of anything right now, and I can't believe that between us, Tiffany, we wouldn't know that if it was starting.
Right.
But keep your eyes on it would be the answer to that individual. But in terms of an institutionalized program that is available all the time, I don't think NSU has that. Lots of universities advertise that. I don't think they are. You're going to tell me you know?
No.
Oh, thank goodness. We were going to get shot, Tiffany. Go ahead.
My question was going to be if you have a list of banks that have that kind of connection
We have
with the government.
I'm
loans.
sorry, I just wanted.
No worries. The access to government loans, do you have a list of banks that have that kind of access?
To the accounts receivable firms?
No, to the government loans. So
Oh, yes. Virtually, let's just take a shot. Who do you bank with currently, personally?
Langley.
Bank?
Langley Federal Credit Union.
Yes. See, the credit unions are a problem because they all say they do SBA programs and they do the 504 program because it's real estate. So, so this is what you go through. So it's a great question. Let's start with the Bank of America. Bank of America does more SBA loans than any bank in the country when the SBA produces a list. But they aren't interested in lending at anything below, it's not above 300,000 just because they don't believe they can make money at it. Okay. Fulton, Atlantic Union are good SBA banks with knowledgeable SBA lenders. I could actually tell you the people to go to. The credit unions say they do it, but I deal with you all the time, and it is amazing how often I can never get to the working capital program. I can always get to the 504 program. So you can see some folks do. Town Bank is another one. They don't do 7A loans, but they will do real estate and 504 loans. So just ask, and I have a conversation like this. I need an introduction to your commercial lending department. I would like to do with a commercial lending officer that, do you do SBA lending? Okay. And if the answer for that is yes, then I ask them the name of the loan officer that knows it, because not every loan officer in a bank, okay, knows how to do an SBA loan or does that. Okay. I can just tell you, just using, again, my favorite, and I bank with them, so I can do this. I've sent people into Bank of America, okay, with a list, and had a commercial loan officer tell them, we don't do SBA loans, just because that particular commercial loan officer didn't know, okay? Those are two. Dollar Bank is one of the smaller banks that does it. Oh, and a very good one, and Joey wouldn't mind me giving his name. Virginia Community Capital is a statewide CDFI community capital bank. And their small business lender is a gentleman named Joey Barnes. If you use that and call him, okay, tell him Bill Holloran and Tiffany Richardson referred you, and he'll think of us kindly. Okay, so that's a good example of one where I know exactly and I know the name of the individual.
Yeah.
Fair enough. And what I usually do with a client is I do just what we did. I said, who do you bank with? If I know that, if you had said Virginia Community Capital, I said, go talk to Joey Barnes. I don't like to break up banking relationships because it's just a pain for you. Okay. So it only takes a couple phone calls up to the Richmond district office of SBA and said, who didn't we name? Who in Truist does SBA loans? Okay. And that's a fluctuating element, but Truist does SBA loans, but their loan officers come and go based on promotions and things like that. So I always like to check in. Okay.
Thank you.
Any other questions?
Let's see.
We've got one here. Go ahead. Yes, sir.
If you were considering bankruptcy and all that.
Say again now?
If you're considering bankruptcy and all that stuff like that,
Yes. Mhm.
should you be concerned about doing this other stuff? Or should you get that straight first, then go into that, or should you?
If you think you have a good business plan, and a thing, if you've had a bankruptcy, I've done this numerous times. Bankruptcies kind of go away after 7 years. Okay. Now it's always on your record. Frankly, the banks will always ask. So you have to disclose it. That's law. Okay. That said, after 6 or 7 years, if everything has been fine, I think you will get a hearing. If you're still within that 7-year period, what I've done with folks who've had bankruptcies is I've turned to private investors. And then I do what we just do today. I said, you can do a debt deal, you can give up ownership, you can do that. So we take the credit evaluation and now it's just an evaluation of where you are currently. Okay. And I've seen that. So you can see I'm dealing with the reality of the expectation of debt lenders, but the private sector now becomes that. Now that may mean that you could say, well, look, Bill, I could go get a bank. If I could get over this, I could qualify for it otherwise now, but they can't get over the bankruptcy. Okay. Now you're going to have to deal with a private lender. So you end up giving up some ownership that you might not have been able to do. But then I sort of come back and go, well, that's the negotiated part. And if it gets your business up and running, someone's just going to make a little bit more money from an ownership position. And hopefully there's still enough money in it for you to make you move forward. Those have been the techniques I have used with bankruptcy. And then once again, you get me out 6 or 7 years. I don't know what the magic is of 7 years. It's just what the bankruptcy attorneys tell me. But 7 years and you have been fine. I walk in and tell them, disclose that right up front. Here's what happened. Never going to happen again. Here's 7 years of history. I want to move forward and then make your case and see if you can get a hearing. Okay, so I would start with the debt lenders. And I would talk, I wouldn't go like to 7 of them. I'd start with 1 or 2, make my case. If you get 2 no's, then you're probably, sometimes it can be the nature, like right now is a relatively tough lending environment because of what's going on with Silicon Bank and all of that sort of stuff. Bankers are a little bit more sensitive. Gosh, through the middle of the 2010s to 2020, what we just talked about would have probably been doable, assuming the business plan was strong enough.
Well, what if you're looking at yourself and you saying in your mind, you need to file bankruptcy, but you just haven't filed?
Oh, you can't file it. If you need to, I would consult a couple of bankruptcy attorneys and move forward.
Okay, what if you've done that too? You consulted them and you know you have what you need.
I didn't hear the last part.
I said, what if you have consulted them and you thinking in your mind, you do need to file, but you're saying, I don't want to file.
Oh, sure. So I had this conversation 2 months ago. The pandemic had buried this woman running a restaurant over there. We laid everything out. I brought everything to the table. We tried a couple of things. We couldn't do it. I send her to an attorney. The SBDC is not allowed to do that. But I gave her, we keep 3 or 4 bankruptcies attorney. I said, look, you need to consider this. Okay. And she hadn't planned for coming out of the pandemic. And all I did was have the same conversation we just had and said, look, debt lenders are going to go out of your life for a while. Okay. If you have to declare bankruptcy, but let's get out from under the element and then move forward. But to start your next business, you're going to need a private investor to do that. And she knew a family member that was willing to do that right off the bat. And I know for a fact that she has moved forward with that, and that's her plan. So once again, that's like right now, she's going to be dealing with private investors if she needs money to move forward after such an immediate bankruptcy. Okay. So, yeah, and you can see in her case, it's, what do we say? Deborah says it best. Oh yeah, life gets in the way. There was a mother who had a medical bill and then, the medical bills just cascade in such a hurry in our society. And that and the combination of the pandemic while she was still operating, were just not allowing her to make any money. She had tried to make it go and had buried herself at a level that is where bankruptcy needed to be considered. That answer the question? Yes, ma'am.
Okay, so precursor, I have a skincare business looking to enter into government contracting for
Did you say a daycare?
skincare.
Skincare, gotcha.
Looking
Okay.
to enter
Gotcha.
for government contracting to
Really?
provide.
Are you
Yes.
going to provide it to the commissaries and that? Is that? Oh, very
That's
good.
the plan.
Sure.
So my question is, firstly, about the account receivable financing organization, as far as you were explaining, they typically works best as a government contractor type way in order to create another type of.
You can see accounts receivable financing evaluates you. Okay, yeah, she can do what she says she do. So you do skincare. Then they go, who did she do business for? And go, the government. The government has its issues, but they pay their bills. Okay. They would do the same thing with a private sector business. They would evaluate the business. Now, if it's a bunch of startup businesses, they might say, I won't take that risk. Okay. And they give you an answer in 2 or 3 days. Okay. Because they're evaluating you and they're evaluating the business that you're going to have the receivable with.
Okay.
And government receivables are pretty good. Accounts receivable firms, you will always get a look.
Okay.
Yeah.
So with that, I guess my next question is, I understand that there's different things through the Innovation Center we have access to, but as far as structuring, like the business plans to show the expansion into more government contracting, do you also do that as well?
Yes, and actually, let's make this simple for you rather than getting in between everything. If you will write down your name and your email address and give that to us before you leave. The SBDC has, every week we come out with seminars like this. Every 2 weeks, there's a Government Con 101, okay, that you can take from wherever you are. I mean, it might be coming from Raleigh, it might come from Northern Virginia. And have you been in business 2 years? Gotcha. So anyway, there are 3 resources you need to be aware of. We can certainly get you the seminars that walk you through how to put together the government element. The second thing is there's a woman in the SBDC network who's a government procurement specialist. Her name is Susan Ball. You'll have to do with her with Zoom. She's up in Fredericksburg. I'm very good at government contracting. She's forgotten more than I know. Okay. And then the third element is I guess I would want to get you with, there is a organization like NSUIC and SBDC called PTAC, Procurement Technical Assistance Center. You send me an email, I'll get you in Hampton Roads. The woman's name is Cecilia Cotton. I'll get her your name, address, and you can get there. The advantage of PTAC is they're government procurement people. So when you get your first contract, you've got someone you can talk to, because a government contract is going to be this much what you are going to do and this much of terms and conditions.
Right.
So you have someone you can talk to without investing $5,000 in an attorney the first time. And then the other thing is they have access to the government contracting databases, so you can see if there's a market for what you're trying to do. And certainly commissaries they could get you to. I think they allow you to tap that once or twice, then it's $150 for a year subscription. So just know that going in. And if you send me that, when I send you her name, I will make note of that. I always tell that.
Okay.
But those 3 steps, and we'll have you going and just say nice things about the SBDC. and NSUIC. We know what to do with government contractors.
Yeah.
Other questions? Do we leave?
I have one more.
Sure.
For you mentioned that you work with, credit, I guess, not necessarily repair, but I guess advisement and
Yes.
structuring and things. So is that also through the Innovation Center? Or
Yeah,
is that
actually,
separate?
those are referrals out. In
Okay.
my case, I have 2 individuals who will agree to see you for free one time.
Okay.
Then you negotiate your own deal, okay? And they're not terribly expensive services anyway. They're just people I trust, I've used for 2 or 3 years. And it's a moving target. I know a lot about it, but once again, I'm not in it every single day. And so I always like, to have the benefit of someone that, this is what they do. Okay, I do access to capital. Okay, I've dealt with enough folks. I've watched people repair their credits and become successful, access to capital folks and things like that. But there's just more to that equation. You'll get into things like, there are loans out there that can help and all of that sort of stuff. And that's what are you on the south side or are you on the peninsula?
Southside.
South side. So I'll send you a woman, her name is Serena Mann. But if you just, when you give me the email address, note that you want that reference and I'll make sure you get that. Okay. Yes, ma'am.
So recap. The 4 important things is how much do you need? You need to know how much you need before you go before.
What you asking, and you wanted done enough planning, so that's specific. That's right.
So get your plan, everything, all of these things should be on your plan before you go to an
Right.
investor. How much I need, what I need it for,
That's right.
I'm gonna use them. What you expect of me as an investor,
In other words, then I want you to apply the underwriting criteria to see
Right.
if you can qualify.
okay?
Okay.
So should we have already determined whether we qualify or not before we go before?
Well, if the answer to that is yes, if you're having a little difficulty to it, because I just showed you one time today and I realized small business owners don't spend all their time in access to capital like someone like me, then you give someone like me a call and we'll size up what you've got.
So it's better to go and get that done ahead of time, so you can actually know. what you-
Sure. For example, no 4 o'clock today, I got the business plan ahead of time. Someone sent me a business plan. They want to raise $400,000, like I said. And they sent me the business plan and I evaluated that yesterday. And I can tell them, actually, my suggestion is going to be find a bank that does an SBA loan because I think they will qualify for that based on the amount that they're bringing to the table. And the business plan looks good. The individual has domain experience. It's their first time as an owner, but they have been in the business they're going to for 19 years. So I think he's going to get a hearing.
So the expectations of the money sources.
Yes.
Number 3.
Or 5, management, repair, in fact, money sources, debt, management, repayability, credit, equity, and collateral.
Well, I was responding to the first thing you said, the 4 most important questions.
Yes. Mhm.
So the last one is, what are the returns that the lender expect or the investor expects of you?
What are the expected
You should
returns?
know that.
That's right. What are the underwriting requirements from a debt lender? What is the return from an investor?
Okay.
Those are questions 3 and 4. Okay, so how much? What is it for? Okay, should I go to debt? Okay, and then I have to have an understanding of what the debt lender's expectations will be, or am I going to have to raise the money from private investors? And then you're talking about ownership and the return on investment that an investor would expect. Okay, yes, sir.
Is it possible to get a printout or copy of like the presentation?
Actually, I think, yeah, if you leave it, we're happy to send the deck.
Thank
Okay,
you.
we use it quite often.
And
Stories change occasionally, but that's it.
And this was recorded, so if you subscribe to the NSUIC YouTube channel. You'll see it uploaded by 5 p.m. on Friday.
Okay, thank you.
Yes. You can always talk to Tiffany. The only thing I have on her is I'm a lot older. So- Yes, ma'am. Did you,
I did, but. I
make sure you
think-
leave your email address. I'll remember. Okay, just.
Yes, everyone, just make sure you sign a sign-in sheet.
Oh, yeah, it's up there. Okay. The SBA Express,
Yes.
if you can just explain a little bit more about like how they work, or if you know how they work.
Sure. Remember, the Express is the line of credit program. So that's the one purpose, short-term thing, like if you were using it for inventory. You would be a good, so I would take, so if you have to buy ingredients to make your skincare element, you would use the line of credit to buy the ingredients, make your products, sell it, repay down this, do it again, okay, depending upon the terms in your business in a given year. Okay, that's an example. SBA Express is simply the government loan line of credit portion of that.
Now, so is
It's
it
no
like
marketing.
something difficult to get, or is it?
The only difficulty is finding a bank that understands it and is willing to do it.
Oh.
Yeah.
But the banks that you mentioned, that I
Yes.
wrote down.
You will be able to find folks that will do
There.
SBA Express.
who do
Frankly,
SBA Express.
frankly, if you put SBA Express in and just ask, you might find there are non-bank lenders out there who don't do anything but SBA. Okay, and if SBA Express is in their list of services, you're good to go. If you do that, send me, just as long as you deal with a non-bank lender who makes their money on the back end. Okay, if someone starts talking to you about upfront fees and things like that, just go somewhere else, okay? There's, as you can see, I can sit down with you and analyze whether you can qualify for a loan. Someone charging an upfront fee saying we'll send you a list without talking about underwriting requirements is not doing you any favors, okay?
But I should be able to, I guess, do a general Google for SBA Express and figure it out, and it
Yes.
tells me.
Actually, and I might SBA Express and start with, put SBA Express in parentheses and in parentheses, state of Virginia, just to keep something local.
Yeah.
Yeah.
Okay.
When you put your thing, put non-bank SBA lenders. There are 2 in Hampton Roads. I'll send you the ones that are local. Okay. Fair enough.
Fair enough. Okay.
Anything else? Are we good online?
What is the agency that you spoke of that deals with medical practices?
It's not an agency, it's a firm. And if that's a doctor or a dentist, just tell them to contact us directly and I'll tell them. Okay. Questions? Everybody good online? It was a pleasure. Thank you very much.
Thank you.